Glad to be here. This is the Retirement Education Hour. I'm joined by Kirk Cassidy and Michael Masserant. They're both financial instructors with the Retirement Education Foundation, and they hold courses on retirement planning. They do this all year long, virtually and in person. And we're going to be telling you how you can attend, how you can get registered for these classes. Deep dive into all you need to know to get set for retirement in the 21st century. Really important. And Kirk and Michael, as we dive into today's discussion, this is a topic I would say is a little confusing. Sequence of return risk, but boy, is it important. We've touched on this in the past. I want you to drive it home today for our listeners, why they need to know what it is. So let's start at the top. What exactly is sequence of return risk?
So, Megan, sequence of return risk is the sequence. It's exactly what it says. It's the sequence of which you are taking money out of your investments, your retirement accounts, once you retire. And if you take it out in the wrong sequence, the timing is poor. We have market volatility. You take too much in the wrong year. A market event happens. The chances of you outliving your money significantly increase. In fact, the general rule is if we have a significant market event in the first 5 years of your retirement, your chances of outliving your money increase by 75%. And candidly, we're going to spend a lot of time talking about this, and we're going to try to illustrate through words, numbers on charts to illustrate how dangerous it is. And we also want to enlighten people why the financial service industry has chosen to ignore this. And it's not new. It's a massive risk. Academia has been telling us for years it's a massive risk. We've experienced it in 2000, in 2008. People have gotten really hurt by this risk. And we have a perfect storm setting up for this next generation of baby boomers who are getting ready to retire to be significantly impacted by it. And so we probably do a show on this every 6 months, and we'll continue doing a show. In fact, it is the reason why the Retirement Education Foundation, that our nonprofit, was founded almost 10 years ago to help people to learn how to navigate their retirement income planning throughout retirement, because the industry is they're just failing to provide custom solutions for people, and the one-size-fits-all is just dangerous, isn't it, Michael?
It is. I mean, this is the number one risk that people don't think about when preparing for retirement. Everyone's focused on returns, or some people focus on tax planning, but not many. But really, I mean, people never think about, well, what order are the returns going to come in, and how is that going to impact the portfolio?
So you're going to experience volatility, right? We're going to have unexpected market events every 4 to 7 years on average throughout retirement, whether it's an election, whether it's a market event, whether it's geopolitical issues, or in this case, a pandemic, right? I mean, we're experiencing. We're going to have these events, and where you take your money from and when you take your money in retirement will dictate whether you outlive your money or not. And unfortunately, for most retirees, you are reliant on an industry, financial service industry, who has come up with these general rules, these one-size-fits-all solutions that ultimately, for most people, they end up way underspending their means, really. And those who decide to ignore some of the rules, they will overspend their means and outlive their money, where there is a happy medium where you can find an ability to maximize your income. And we teach in the courses we teach, where you can take 7, 8, 9% a year out starting in your 60s and not outlive your money if you take the right sequence of distributions to eliminate that sequence of return risk. And it's why we started this nonprofit organization almost 10 years ago called the Retirement Education Foundation. We host 7, 8-hour courses that are held at all the major universities: University of Michigan, Eastern Michigan University, Michigan State University, both the Novi campus and the Troy campus, that's it, Oakland University, and also here in Livonia at our Learning Center. These courses, we're also streaming them during COVID, so you can experience the 7-8 hour course from the safety of your own home. It's a 200-page textbook. All you have to do is make $29 donation to charity, and you can attend this course. If you'd like to register, go to retirementplanningedu.org, retirementplanningedu.org, or you can call 800-240-8981.
Megan Mozak alongside Kirk Cassidy and Michael Masserant, talking about something that affects you maybe more than you think. You've probably heard of sequence of return risk. And Kirk and Michael, they're explaining what it is and how it actually does impact you. So tell our listeners what they can expect throughout the show today.
Well, we're going to give some illustration. We're going to give some numbers of examples where historically people have been trapped by just bad timing, retiring at the wrong time and following the industry standard rules, and it's caused them to outlive their money. We're also going to sort of hopefully give you an idea of when you hear these general rules, when the industry is talking to the masses, who exactly are they talking to? Is it you or is it somebody else? Because I think that's where the big disconnect, Michael, is I think when we look at the general rules that are being provided, and you read the books, the talking heads, the Susie Ormans, the Ramseys, all these people, they're talking to the average retiree. And when I say average retiree, I don't think people recognize the average baby boomer is only going to retire with $200,000 saved for retirement. That's it. And those rules may be fine for those with $200,000 saved. Those people who have saved more, those rules are going to create problems, either underspending or overspending because of bad timing.
You're right. I mean, for people who have saved resources, those rules don't fit. And they're essentially asking those people to self-regulate and self-monitor. Rules like protect your principal. Well, if you're protecting your own principal and only spending the growth, you're never going to spend down your assets, and your advisor never needs to do any real planning.
Well, it's self-regulation, right, Michael? So they're saying, okay, here's the 4% rule, live on 4%, and just protect your principal so when the market gets volatile, you won't spend as much as the theory. You'll self-regulate. So in other words, you're going to allow short-term market events to dictate whether you go on vacation, you do a home improvement, whether you even retire or not, right? And so that, in our opinion, is a shame. You've spent your entire life. This is supposed to be your golden years, saving money for this period of time. You shouldn't allow market events to dictate when you're going to do things, particularly towards the end of your life when you don't know when the end is coming, right? So in our courses, we spend almost 8 hours and we teach, go through a 200-page textbook, and we teach people how to construct an income plan in retirement, when and how to take income from which accounts at what age to minimize taxes and eliminate sequence of return risk. If you'd like to register for this class, all you have to do is make a $29 donation to charity, and you can call 1-800-240-8981 or go to retirementplanningedu.org, retirementplanningedu.org.
We're back with Kirk and Michael straight ahead. Glad to be here with Kirk Cassidy and Michael Masserant. This is the Retirement Education Hour. I'm Megan Mozak. Don't forget, you can follow Kirk and the team by liking their Facebook page. Just go to Retirement Education Foundation. Now, Kirk and Michael, we're talking about sequence of return risk. Give us a quick recap on what that is before we move on.
So it's taking money out of your investments in your retirement years from accounts when the market is down. Right? So it's what sequence of events, right? So I need money to live on. So I'm going to pull my 4, 5, 6% out of my 401k, my IRA, my taxable accounts, wherever I'm taking my money from. And when I take that money out, the market also happens to be down at the same time. This is compounding the losses. And if that happens and we have a correction, not even a recession, but a correction in the first 5 years of retirement, your chances of outliving your money increase by 75%. This is the number one risk for baby boomers heading into retirement or in retirement right now. And so what we want to explain is, I think this segment, Michael, let's talk about what the solutions the financial service industry is currently providing for these problems and why that isn't the best solutions. And we'll eventually, as we go along the show here today, we'll get into some of the solutions on how to avoid this mistake.
Right. So first of all, the industry does not typically address this very often. I mean, you and I both say this is the number one risk, and I bet you a lot of people haven't heard of it before. And that's because the industry does not want to talk about this because they don't have a great one-size-fits-all solution yet. I'm sure they're working on it. And as soon as they figure one out, they're going to market it. But they don't have one yet.
They've been trying for a long time, right? It's because here's the problem. It's not scalable, right? It's not scalable and profitable, right? Their goal in the financial service industry is to meet as many people as they possibly can and sell you as much as they can and move on to the next person. But to build a plan that pivots around sequence of events, it would require it to be customized to the individualized person based upon age, gender, right? Are you married? Are you single? How many years before you're going to retire, or are you in retirement? How many years of retirement are you going to have? What your tax situation is when you're taking. So there's so many variables. It requires customization. Customization takes way too much time, and there's no software to give them these answers. There is not a software that exists to provide this type of income planning to eliminate this risk. So they come up with simple rules like, Michael?
So the first one they've come up with is just simply keep working.
Right.
They think if you're not sure if you have enough or not, then just keep working. So people,
at least until Social Security starts. How many times do people come to the class, right, and we say, well, why are you working? And they say, because I got to work until I hit retirement age. They've got $3, $4, $5 million. They're working till Social Security starts because their advisor said that's what they're supposed to do.
Or until Medicare kicks in. That's another excuse, right?
These are so many people will work way beyond the years they need to because they don't know what their money will provide them or what the right path to get the maximum amount of income out of it without outliving it.
And this is difficult to tackle because no one knows if we're going to have a correction next month, next year, 3 years, 5 years. No one knows. So people, since they don't know, they don't have an answer in front of them. They decide better be safe than sorry. I'll just keep working.
Right. So that's one solution they give you. What's another one that they use?
A second solution is to spend less money during market events, during corrections.
This one is the one that bothers me most, right? Because losing, I don't know how many in our private practice this year, Michael, off the top of your head, how many people did we lose in their 50s and 60s?
Probably about 11 or 12 people.
Right. That's just in our private practice. Yes, in our private practice, we're responsible for about $1 billion, and we have somewhere around 1,000 clients. We lost at least that many people in their 50s and 60s, not to COVID, to cancer, to strokes, to heart attacks. You just don't know how long you have, right? Your window of retirement could be really small and it could be really large and you just don't know. So this idea of if and when we have market events, we should alter our spending habits. Well, you may only have this small window to do any of the bucket list items you've worked your entire life to do. Remember, when you're younger, you have earned this money. You are serving your money, right? You're serving it to save it for retirement. You're serving it to take care of your family, put your kids through school. You are serving money. Retirement, you're supposed to transition. Your relationship with money needs to change to allow money to serve you, right? It's there to serve you. And if you are continuing to serve your money when you retire because of market events, allowing the market to dictate whether you're going on vacation, whether you're going to do a home improvement, whether anything, any of the things that you have on your bucket list items that you otherwise could be doing if you had a real plan, then you're still serving money because your advisor told you spend less during market volatility.
Well, it's also not healthy to be checking the market and checking your portfolio to see if you can do these things. Well, you don't want to get in the habit of checking your portfolio before you book a vacation to see if you can do it. It should be part of your plan, part of your income for that year.
Michael, it's so important because what people who haven't retired yet, the people who've retired, they know something that those who have not retired they don't know yet, right? And that is truly your relationship with money is going to change. You are never going to feel more vulnerable to your money than once you retire. We meet people all the time. Michael's the one that came up with this, and he's right. People come to us. We always ask, so how did you behave in 2000? And how did you react when 2008 came around? Consistently, the message from baby boomers are they wear it like a badge of honor. We were disciplined investors. You know what? We didn't panic because we know we're smart enough to know, right? And we giggle because they don't understand. What they didn't understand is someone else was paying them a paycheck to take care of their lifestyle every single year. They had time to let it recover, and they had someone else paying them while it was recovering. The next time that happens when you're in retirement, you only have yourself to pay you. No one else is paying you. It's just you. And when you see your $1 million of money go down 20, 30%, and now you have $700,000 in the first 5 years of your retirement, your behavior is going to be different. So part of this education, part of this planning, part of addressing sequence of return risk is about giving people that freedom in retirement to not let who's being elected or who's being impeached or short-term market events to dictate what they're spending and when they're spending it. Because then you may be missing your only opportunity when you're healthy enough to do these things. And that is sad. And it's driving us to teach these classes. We've been teaching at all the major universities around Michigan. They're 7 to 8 hours. We teach them in one full Saturday or 2 evening courses, back to back, Tuesday, Wednesday. We go through a 200-page textbook. Now, look, this is a pretty quick-paced class. We get a lot of engineers, executives, do-it-yourself CPAs that are attending this course. And all you have to do to attend the course is to make a $29 donation to charity. So if you'd like to register, you can go to retirementplanningedu.org. That's retirementplanningedu.org or call 800-240-8981.
And we'll be back. More Retirement Education Hour straight ahead. This is the Retirement Education Hour. Glad to be here with Kirk Cassidy and Michael Masserant. They're financial instructors with the Retirement Education Foundation. Be sure to search the foundation on Facebook so you can be up to date on all that the team there is doing to help you stay connected and on the right path for retirement. Again, search Retirement Education Foundation and like the page. Now, Kirk and Michael, we've been talking about sequence of return risk. The financial planning industry, there are some rules of thumb, some guidelines that maybe are just not hitting the mark any longer. What are a few of those?
Well, we went through a few of them in the last segment, but I think there's a few more we'd like to highlight because I know many of our listeners here are hearing this regularly. This is the default planning for retirement in our industry, in the financial service industry. So, Michael, give me another one that we're commonly hearing.
So a pretty common approach is the bucket strategy, right? Having one bucket set aside for long-term growth and having one bucket for short-term expenses, whether that's cash, a bond ladder, CDs, something of that nature.
Can we blow that one up real quick? Because so the obvious is the bond ladders, which is something we used to do all the time. And let me not suggest that we don't use bonds. We do still use in our private practice. We utilize individual munis, municipal and corporate bonds. No bond funds, only individuals. But the day of laddering muni bonds for retirement income does not exist in this environment and hasn't for a while. But yet still people are doing this. And the problem is we're in the lowest interest rate environment in history, period. And there is no way, look, when you've got all the major firms their forward forecast of a 60-40 model, 60% stocks, 40% bonds, their forward projections are 3% or less. You can't build a retirement plan on laddering of municipal bonds. Bonds is not going to be the playbook anymore. And you're seeing the industry starting to pivot from that. And their solution, of course, is go more equities, and that's a whole different discussion that we're not going to get into today. The second one is cash. I've heard this more recently a lot, where they're being told to keep 4 or 5 years of cash or cash alternatives, CDs, money markets, in a bucket just to pull their income out of. And yes, this would work. And yes, that would help to eliminate sequence of return risk. Wouldn't it, Michael?
It would. And candidly, this is probably none of these options are great options. This is probably the best one for an unsophisticated person trying to do this on their own.
Right. The result is you're going to way underlive what you otherwise could have. You could have created a lot more cash flow if you wouldn't have 5 years of cash dragging down the performance. You don't need to do it that way. That is such an underperforming strategy. Is that fair?
It is. And it's too broad of an approach. It's like approaching surgery with a hacksaw. I mean, this needs to be more finely tuned than that.
Yeah, and I like that too, Michael, because people sometimes get themselves trapped with that strategy. With good intention, they start that way. And yeah, it's probably the most conservative approach. And as a result, you're going to get less income in retirement. And for some people, they're fine with it. The problem is, as the years go by and the cash starts to drain, they don't realize, I got to pivot and take see, that strategy only works if you keep 4 or 5 years of cash always in cash or cash alternatives. In other words, 2 years have gone by. You need to replenish that bucket so that you maintain that 5 years of cash. So the trap can be, is what happens next year or the following year with the market. Is the market down 30% and then you have to fill your cash bucket? That means pulling money out of a investment that is down in value. Look, at the bottom line is you never, ever, ever want to take distributions out of portfolios that are going down in value because it is going to compound the problem. And this is why average rates of returns are irrelevant, Michael, right? People really struggle when we talk about this in our class on the radio when we tell you performance is not driven by average rates of return in retirement. It's different in retirement, right? Average rates of return can be skewed, particularly when you are pulling money out of those accounts.
Right. The timing of those returns, when those good years or the bad years happen, if the bad years occur early, you're really going to be struggling to meet your income goals.
So, Michael, I think this is a really good time because to give one of the illustrations that we go through in the class. And we show a scenario where there's three portfolios, portfolio A, B, and C. And we take a 5-year return on different sequences of returns over those 5 years over all three portfolios. And so the first portfolio, the first year, they earn 22%, then they earn 15 in the second year. They earn 12 in the third year. They lose 4 in the fourth year, and they lose 7 in the fifth year. If you averaged all of those 5 years together, that's an average rate of return of 7%. Then if we looked at portfolio B, the portfolio B had a positive return of 7 the first year, 7 the second year, 7 the third year, 7 the fourth year, and 7 the fifth year. All the same. Right? That is an average rate of return of 7%. And then if we look at portfolio C, where they lost 7% the first year, they lost 4% the second year, then they make 12, 15, and 22. So all three of these portfolios have an average return of 7%. And if we took out 5% a year to live on throughout the retirement, and that was the 5-year sequence they got, one portfolio runs out of money at about 86, 87 years old. The other portfolio still has $400,000 of their $1 million they started with left at 90 years old. And the other portfolio has $1.1 million left at 90 when they die, right? The only difference was the order of the returns, but they all had a 7% average rate of return, Michael.
Right. That's why when people come to us and they say, oh, well, I've been averaging 10% per year, we tell them that's not going to help you in retirement. If you have bad years early and you're taking income out early from those portfolios, you're going to run out of money.
Period. It's the average rate of return isn't what drives performance. What drives performance is when do I take income out of which accounts at what age to minimize sequence of return risk and reduce taxes. Big one is taxes, right?
Absolutely. And to clarify, that's a $1 million difference between the portfolio that won early, which had $1 million left at the end, and the portfolio that lost early, which finished with $0 at around 87 years old.
Right.
Which, to no fault of that investor, they can't control the market.
Right. And they both had 7% average rates of returns. We try to shake people because they don't hear us. And this is why the more money you have, the more you need this education, right? That's why we attract typically people with investable assets of over $1 million to the class. Look, if you're the average retiree retiring with $200,000, these general rules typically will apply and they'll work. But once we get above that $200,000 and we have resources, you need a more customized individual solution. And so the education helps you to know what to look for. It's a 7-hour course. All you have to do is make a $29 donation to charity. You can attend by registering at retirementplanningedu.org, retirementplanningedu.org, or you can call 800-240-8981.
And we'll be back with Kirk and Michael straight ahead. Glad to be here with Kirk and Michael today for Retirement Education Hour. They are both financial instructors with the Retirement Education Foundation. If you'd like to register for one of their upcoming courses that are taught at local universities, including University of Michigan, Eastern Michigan University, Michigan State University Novi campus, or Oakland University, call today. Here's the phone number if you'd like to do that, 800-240-8981, or register online, retirementplanningedu.org, and search for that on Facebook as well, Retirement Education Foundation. Now, Kirk and Michael, we've been talking about some of these rules of thumb that just simply are outdated. They don't work. They miss the mark. And we've been discussing a few of those. There are more still. Tell us about some of those.
Well, it's really these rules that they're trying to prevent that sequence of return risk, right? They don't tell the retirees what the biggest risk is, but they're trying to come up with these quick, easy solutions. And one that I'm sure many of you have heard before and have heard regularly is my principal should be protected. It's something that actually you have all been conditioned. Over the years, the financial service industry for years have been conditioning you and teaching you to believe that you need to protect your principal in retirement. And I want to define that for people because when we do this in the class, I think people are shook by what this means because it's not what many of you really want, right? If you are going to protect your principal, that means what you retire with will be the same amount of money that you'll have when you die. In other words, you are going to pass to your loved one, your heirs, exactly the same amount of money you retired with. That's protecting your principal. And while I know some people, we meet a ton of people actually, where legacy is important. What they leave to their loved ones is really a priority. For many of you, what you really are looking for is a controlled spend down of your principal. Just don't let me outlive my money. That's the key. But see, the problem is, and why the industry does not give you that option, is because they don't have a solution to allow you to have a controlled spend down, because that would require a lot of work on their end to manage, navigate, regulate, be able to pivot when we have market volatility so that you can maintain the lifestyle you're currently having. You don't have to change anything. That would require a lot of hours of planning. And candidly, the industry isn't willing to spend that because that's not profitable.
They're not. And it's easier for them to just say, you manage this on your own. If you make 5% this year, spend 5%. If you lose 10% next year, don't spend anything. Protect your principal.
Protect your principal. It's really a tool to have you self-regulate.
And like you said, that's not a goal of some people. Some people, if you retire with $1 million, they're not looking to pass on $1 million to their children. They want to spend it down. And if you're protecting your principal, you're not going to spend those assets down.
So it's one of two things. Either they've been instructed, that's the best way to do it, or two, it's really as they retire and they become more vulnerable and their relationship with money changes, they become more anxious about their money and outliving their money. There's too many variables they don't know how to handle, like long-term care costs, recessions, one spouse predeceased. There's so many variables they don't know how to navigate and manage. So it's just so much easier to protect my principal. But Michael, we know this is why most people, most baby boomers with resources will way underspend what they otherwise could be spending if they just understood where the traps were and how to design an income plan to eliminate these traps.
This is why we say in the class, older people are not cheap or frugal, they're scared.
Perfect.
They're afraid of outliving their money because they're afraid if I splurge on a vacation when I'm 65, will I live to regret that when I'm 90?
See, you don't have to live with that fear. And you're going to say, many of you might not be willing to accept you have anxiety and fear, but it's there. Trust me, your relationship, you'll get it. You'll feel it. You don't have to accept that. That's why we spend 8 hours educating people, right? And look, if you're the average retiree retiring with a couple $100,000, really this class, those general rules are going to be fine for you, right? I mean, because you really do need to protect your principal, because if you do have a health event, there's just not a lot of resources. But for those people who really have saved money for retirement, you got to understand that there are custom solutions to be able to build your plan, to be able to drive more income out of it without any chance of outliving your money, with all the potential traps accounted for. But that requires so much work and time. And that's why before you make any decisions, spend the 7 hours and educate yourself. I mean, that's why the foundation was created, is to provide financial literacy for people, baby boomers approaching retirement or in retirement, but not basic financial literacy. This is a little more advanced. Really technical in taxes, income strategies, investment strategies. It's really more of an advanced, it's not a 101 class. Is that fair?
It is. And I mean, it's shocking for something as important as retirement. Some people are unwilling to sort of pull back the curtain and get a better understanding of how is this going to work and where's my income going to come from and how protected am I?
It's because they think the same strategies that help them to make the wealth. Baby boomers are a very successful generation. They've made, in fact, the greatest transfer of wealth is going to occur from the baby boomers to their children. That's for two reasons. One is they've been very successful financially. They've made really good choices. Two is they'll way underspend their means. They will just not spend the money out of fear, so their loved ones are going to end up having the greatest transfer of wealth ever. $76 trillion is the projection. It's a ridiculous amount of money.
And on the website, speaking of sequence of return risk, we have a calculator. We have an interactive calculator that you can use to plug in. Okay, well, if I lose early, if I have a couple bad years early, what will that do to my portfolio?
Yeah, I think we give a 5-year sequence and a 7-year sequence where you can plug in different returns and different withdrawal rates with inflation accounted in. I'll give the credit to Josh, who created the calculator. It's a really neat calculator. But it's interactive. It gives you the ability to see where the traps are and better understand the trap. And our goal by providing those calculators is that it motivates you, even those CPAs and portfolio managers. We have pension fund managers that attend these courses. This course, it doesn't matter how successful you were with choosing investments. Because retirement planning, that's the easiest part. Your investments is the easiest part of retirement. It's when and how you take the income from which accounts at what age to minimize taxes. How do you protect your surviving spouse? Because major tax changes when one spouse dies. And there are Medicare traps. There's all kinds of traps that are avoidable if you plan for retirement. And so we're going to encourage you to take this 7-hour course. We're teaching them at all the major universities. During COVID, we are streaming them live so you can stay in your home. We also have small groups that we're allowing groups of 10 or less to attend these courses while we're streaming live to you in our Livonia office, in our Livonia Learning Center. And I think Michigan State, the Troy campus is about to open back up. I think the schools will start to open up and we'll get back in all the universities again. It's a $29 donation to charity. If you'd like to register, go to retirementplanningedu.org, retirementplanningedu.org, or call 800-240-8981.
We're back with Kirk and Michael straight ahead. I'm here with Kirk and Michael, Kirk Cassidy, Michael Masserant of the Retirement Education Foundation. They're both financial instructors. This is the Retirement Education Hour. We've been talking about, a lot of things here on the show. I've gotten quite an education, sequence of return risk, also rules of thumb in the financial industry that just aren't hitting the mark anymore for a variety of reasons. As we talk about sequence of return risk, I want to talk about this time that we're in right now, the market at an all-time high. Sounds great, but Kirk and Michael, you say that could actually pose a risk to people thinking about retirement right now. How so?
So we're really cautious because a lot of people in the financial service industry uses fear to drive action. I mean, it's human nature. That's Psych 101. That's fine. We're good with it. What we're always trying to be cautious of, that to not use fear to drive an action to buy or do something. We want to use the fear because there's plenty of things to be fearful of as a baby boomer going into retirement right now. But the what we want to drive using the fear that really exists is the reason why you need to spend some extra time becoming more educated around the different strategies and traps associated with retirement planning, how it is so different than growing your wealth. Distributing your wealth requires different planning and strategies. And so it's really, for us, this is a really, really pivotal time for a lot of baby boomers. And a lot of you felt it this year, right? We've got markets at an all-time high. And I know many of you think that you're going to be able to decide when you're going to retire. And unfortunately, many baby boomers learned this year that they didn't get to decide whether it was a health event, whether it's a recession or a pandemic, cutbacks in a company, age discrimination, which is very alive, by the way, especially given COVID and corporations seeing the efficiencies through being at home, working from home. They can cut back on staff. They can get more done. You aren't always going to get to choose when you retire. And right now we have a market at an all-time high. So this idea that I've got 5 years to retire so I can continue taking risk, I don't need to plan for retirement, I'll plan once I get closer to retirement, is crazy. Because what could cause you or force you to be retired is a crash. So when the recession happens or an event happens, both your retirement accounts are going to be way down and you'll be losing your job before you thought you would. Michael, that's a perfect storm. That is why we're so worried about sequence of return risk right now.
It is. And I mean, like you said, a lot of people are saying current valuations are stretched in the stock market. We're at all-time highs. And I mean, you never want to call
bubblicious.
You never want bubblicious. You never
want a little bubbly right now, folks.
You never want to try to time markets or call tops. So I mean, Ray Dalio and Peter Lynch in 1995 tried to call a top in 95. And then the next 5 years, there was about 100% run in the stock market.
Yeah, we don't want to call tops. We don't want to time markets.
But you need to be prepared if something does happen to your job, if you have to leave your job unexpectedly, that you're protected from sequence of return risk, especially now when we're at all-time highs in the stock market.
I would want, if I was close to, I'm telling you, if I was within 10 years of retirement right now, I would for sure be preparing as it could happen 3 years, 5 years, 7 years, and I would make sure I knew whether I had enough to give me what I wanted in retirement. And if I didn't have enough to give me what I wanted in retirement, how much longer do I need to work? How much risk do I need to take to get what I want? And make calculated decisions based upon risk, based upon needs. You got to start to pivot. These general rules, when you have resources and you have a bigger lifestyle than the average baby boomer, folks, you got to understand 40% of retirees get 90% of their income from Social Security. So those of you who have resources that plan to live on $80, $100, $150, $200, $250, $300,000 a year in retirement, that's not average. You're not average. The average retiree lives on way below $50,000 in retirement. So you got to be careful when you're hearing these general rules about risk where you should have an asset allocation. When you have resources, Warren Buffett said this, right? And I say this, I think, at almost every show. You have to be insane to risk what you have for something you don't need. In other words, you need to drive your decisions about risk, how you invest, how you set up your retirement plan based upon what you have and what you want or need in retirement. Not what the book says, because I'm 60 years old, so I should be a 60-40 portfolio. It's silly.
And a great example of people who are caught off guard was back during 2000. Looking back, we now know that 2000 was probably one of the worst times historically in modern history to retire. Now, people retiring at that time couldn't possibly know that. They didn't know that they were on the brink of the dot-com crash, and then 8 years later, the Great Recession. They couldn't possibly know that.
The lost decade.
And so for people who did not prepare, they lived a drastically lesser lifestyle than they were planning on.
Oh, or they're gonna outlive their money,
right?
Because they got caught. Sequence of return risk, right? So it's a shame. It's funny. During that very similar period of time, Fidelity did a study, a 10-year study, looking at what the best performing portfolios, who performed best, and what they found was people who were dead over that 10-year period had the best performing portfolios out of everybody, the $7 trillion of money that's at Fidelity. That's better than the fund managers, the mutual fund managers, everybody. If you were dead, you were going to perform better, right? And so I say that on purpose. Michael's probably wondering, why am I bringing that up? Because I know many baby boomers who have resources have done really well in the market, and they think they've got something figured out. They think they've got it figured out enough that they can navigate this choppy waters of retirement. You don't. And it's going to be irrelevant what you invest in. What's going to be relevant is when you take your money from which accounts. But you don't know that yet, right? So remember, this is the first time you're ever going to plan for retirement. This is the first time you're going to go through this process. In this room, there's probably a consolidation of 5,000 people we've helped to some degree navigate through retirement. We've seen it all. We know what you're going to do in your 60s, 70s, 80s, 90s. We know how you're going to behave. We know where the traps are. We have been teaching thousands of people for years how to navigate this. More importantly, is how to maximize this, because most of the people that attend our course have resources. And what we typically find is that we're able to show them through education that they're going to be able to spend a lot more money than they thought. It was just going to be done much differently than they thought, right? And so this is why you got to spend 8 hours, invest 8 hours of time and make a $29 donation to charity. And you can attend this course. These are courses that are held at all the major universities. We're streaming it live during COVID. And if you want to go to a small group right now, you can come to a small group in our learning center in Livonia where we limit it to 10 people. We're going to go through a 200-page textbook. It's 7 hours of education. If you'd like to register, go to retirementplanningedu.com, retirementplanningedu.com, or call 800-240-8981.
And we'll be back. There's more Retirement Education Hour straight ahead. We're glad you're with us right here on the Retirement Education Hour. I'm Megan Mozak. It's a pleasure to be alongside Kirk Cassidy and Michael Masserant. They're both financial instructors with the Retirement Education Foundation. Now, you heard us talk about these courses that Kirk, Michael, and the team teach throughout our community. Don't forget, you can get registered online. It's very easy. retirementplanningedu.org. That's retirementplanningedu.org, or call 800-240-8981. 8981. Speaking of planning, Kirk and Michael, that really is the key, isn't it?
So yes, the answer is planning, right? And that's what we teach in these courses. How, when to take income from which accounts, how to manage your tax brackets, understanding what's taxed in which bracket, how your Social Security is taxed, right? What drives the decision on when to take your Social Security, one of the major variables is taxation of Social Security and how it impacts the taxation. Social Security impacts taxation on your IRAs and 401ks, right? So it always comes down to planning. So before we get into more detail about planning, I just want to pivot for one more second and give an example of two portfolios we illustrate in our class, right? So in our class, as we're talking about sequence of return risk, we spend a lot of time on that. We probably spend a good 40 minutes on, maybe an hour, on just sequence of return risk. We show an example of two different people's portfolios. And essentially, they're the same returns over 20 years, just in reverse order. So one will start with a 33% rate of return, and then over 20 years, the average rate of return will be an average of 10%. The other one actually starts with a negative rate of return the first year, but over all 20 years, it's an average 10% rate of return. Both of them started with $1 million. They're both going to retire and take out 5% a year or $50,000 to live on. So what we're doing is we're comparing two different portfolios, one with early profitable returns, good returns early, and one with early poor returns, both with an average rate of return of over 10%. The one that had the early good returns, 20 years later had $2.8 million left when they died, or 20 years later, I should say, not when they died. The one that lost money early but still had an average rate of return of 10% ran out of money in 17 years. So if you think about the portfolio that did poorly and ran out of money, they had an average rate of return of 10%. They took out 5% a year to live on, but ran out of money in 17 years. It's because they lost early, Michael.
And again, there's just no recovering from that. If you lose early, so if you think about it, if you have $100,000 and you lose 50% in year one, you need a 100% gain to get back to break even, let alone if you're pulling money out of that portfolio.
Well, that's where people get in trouble, right? Think about it. Let's say you lose 27% in the first year. No, let's call it. Let's say you lose 29% in the first year, and then you take out 5%. So now you're 34% behind. If you're 34% behind, to catch up to even the next year, you need 54% return, right?
Right, because first, I mean, the shares you're pulling out of the market to live for income are no longer invested to recover anymore.
Right, you have fewer shares to recover from.
So sure, the market will recover, just like everybody always says, but you no longer have the ability to let the funds sit there and recover with the market. Now you're pulling that out for income.
In fact, Michael, that's one of the phrases that drives me most crazy. So when you're young, yes, stay the course. It's a roller coaster ride, and over time, you're going to be fine. In retirement, you aren't going to be fine. If you are pulling money out of portfolios that lose early, you can't recover. You won't recover. Time won't help you there. You need to prevent that from happening to recover. You just can't let it happen.
And people really hate addressing this issue just because there's an element of luck here, right? No one knows what the market's going to do. There's no preparation. You don't know, am I going to retire in a good time or a bad time? The only thing you can do really is planning.
Well, Michael, right? So they say, but I could have had, if I just stayed long and didn't worry about this and the timing was good for me, I'd have so much more, right? And this goes back to why we challenge people. You have to be insane to risk what you have for something you don't need. In other words, look, if you have enough to give you what you want in retirement, Now you're just being greedy. Now you just need to know if you have enough and then map out the income strategically so that you don't make a mistake to accidentally outlive your money. Because you're not going to know it when you made a mistake. It's going to take many years before you figure out you made the mistake. And it goes back to planning, Michael.
Right. I mean, at that point, it's too late. If you've made that mistake and you realize it a couple years later, it's already too late. You can't recover from that anymore.
It's why it drives me crazy when say, well, I'm 5 years from retirement. Maybe I'll go to the class, a year or two before I retire. No. It's never too late to retire, but the earlier we start, the better off you are. Because you got to know where you're at to determine what the best path to get to where you want to be, right? And the earlier start you have, you can avoid so many risks. You can position yourself for more Roth conversions. You can position yourself to leave your surviving spouse in a better position. Give yourself more income. You can really avoid so many traps if you start earlier. You got to educate yourself within 5 to 10 years of retirement.
And also, the earlier you educate yourself, the better prepared you'll be. I mean, how many people come to the class and then come meet us and we say, you could have retired 3 years ago?
The majority of the people that we work with could have retired earlier because we tend to work with people with resources and they just didn't know. Like there's no one in the sky that's going to talk down to you, my son, do you have enough to retire? Or my daughter, you have enough to retire. There's no flashing light above your bedpost that's going to say, okay, you got enough to retire now. There's no alerts that's going to say, you won the marathon, you can stop running now.
And it's not round numbers. It's not 1 million, 2 million, 3 million. Everyone's different.
I hate that, right? We hear that a lot. I had to send my mind. I need 3 million before I retire. 3 million's good. Just from the 3 million, you could create over $200,000 a year. Just without pensions, Social Security, which is more than they're probably living on now, right? So people just don't know what their money could do, and fear prevents them from really utilizing those dollars properly. And I'm glad they're afraid because you don't want them to outlive their money. But education, 7-8 hours of education on how to construct that individualized custom plan gives them people the freedom. And I hope this show is helpful. It's the reason we started the nonprofit organization almost 10 years ago, just specifically to help people to and through retirement. So if you'd like to register for one of our 7-hour courses at all the major universities and streaming online, all you have to do is make a $29 donation to charity, and then you can register at retirementplanningedu.org, retirementplanningedu.org, or call 800-240-8981.
Investing involves risk, including the potential loss of principal. Any references to protection, safety, or lifetime income generally refer to fixed insurance products, never securities or investments. Insurance guarantees are backed by the financial strength and claims-paying abilities of the issuing carrier. This radio show is intended for informational purposes only. It is not intended to be used as the sole basis for financial decisions, nor should it be construed as advice designed to meet the particular needs of an individual situation. Retirement Education Foundation is not permitted to offer, and no statement made during the show shall constitute tax or legal advice. Our firm is not affiliated with or endorsed by the U.S. government or any governmental agency. The information and opinions contained herein provided by third parties have been obtained from sources believed to be reliable, but accuracy and completeness cannot be guaranteed by Retirement Education Foundation. This radio show is a paid placement.